Okay, today we're going to talk about Chapter 2, 3, analyzing how transactions affect owner's equity accounts. So it's going to be almost like Chapter 1, Lesson 3, where the only thing we're going to talk about, except for a couple of little exceptions, is how things affect the owner's equity account. So when we receive cash on sales, receive sales on account, withdraw an asset, so forth. So first of all, we're going to receive cash from sales. Remember, this goes back to our realization of revenue. So on January 10th, received cash from sales, $1,100. So we received cash. So we got to remember our four questions. So what two accounts are going to be affected? We received cash, so cash is going to be one, and sales is the other one. Okay, what type of an account is cash? Well, it's an asset. What type of an account is sales? Well, it's an owner's equity account, revenue. So what happens to the asset cash? Well, we received it, so it has to go up. And because our cash went up, we also increased our amount in sales, so that goes up. So then the last thing is, how do we record an $1,100 increase to cash? Well, remember the debit side is the increase side for cash. Okay? So we're going to record $1,100 on the debit side. Sales, because it's on the right side, it's a credit increase. So we're going to record an $1,100 increase to sales. All right, so the next one is we sold services on account to Main Street Services, $500. So again, we got to decide what two accounts are going to be affected. Well, we're going to receive cash at a later date, so it's accounts receivable, Main Street Services, and again, it's going to be sales. Next is what type of an account is accounts receivable? Remember, it's an asset. And remember, your sales is a revenue account that affects owner's equity. So how do we change the asset accounts receivable, Main Street Services? Well, it's going to be increased. The same thing with your sales. It's going to increase owner's equity. And finally, so to increase accounts receivable, we put $500 debit. And to increase the sales, we're going to credit $500. Remember, you always have to have at least one debit and one credit. So now we're going to pay cash for expense. We paid cash for communications bill, for cell phone and internet service, $80. So again, we got to decide what accounts are going to be affected. Well, cash, we paid cash, so that's going to be affected. And we have a communications expense, communications bill. So if you look here, we have a communication expense account, which will eventually affect owner's equity. So now what type of account is cash? Well, cash is an asset. Communications is an expense account that affects owner's equity. So how do we decrease? Cash is going to be decreased, so assets are going to be decreased. We're going to actually, owner's equity is decreased, so in a way we're going to increase the owner's equity, or increase the expense. So cash is going to be credited $80 to show that decrease. And the expense account is going to be debited, and you'll kind of see more why that's going to happen as we get into some other chapters. But the communication expense is going to be debited, so eventually will decrease the owner's equity. All right, received cash on account. So cash on account, we received $200 from Main Street Services. So the accounts receivable, cash is going to be affected, and accounts receivable, Main Street Services. Both cash and accounts receivable are assets. Asset is going to be, cash is increased because we received cash, and the asset account, accounts receivable, will be decreased because they paid part of what they owe. So finally, we're going to debit cash, $200 to show the increase. We're going to credit accounts receivable, Main Street Services, $200 to show that they paid. Now, just kind of remember, we've already recorded the sales, so that's why there is no sales account. It's just cash and accounts receivable. All right, paid cash to the owner for personal use. Michael Delgado withdrew equity from the form of cash, $350. So what two accounts are going to be affected? Well, he withdrew cash, so the cash is going to be affected, and his drawing account will be affected. Remember, cash is an asset. Michael Delgado drawing is an owner's equity account that will eventually decrease the owner's equity. So in this case, we're taking out cash, so the asset cash is going to be decreased. And we're going to increase withdrawing, which will eventually decrease owner's equity. So we record a cash credit for $350 to show that decrease. And we record $350 debit to the drawing account to show that account.